These are the 16 investments I made for the month of July. For the month of July, after expenses and everything, I had $5,000 left to invest. And no, I am not a millionaire. I just got my bonus the previous month. And I thought, why not funnel most of this bonus for my yearly work as a corporate employee and someone who adds tremendous shareholder value? Why not take this and put this in the stock market and become a shareholder? I'll be going through each investment, my reasoning for making this investment, and how I think these investments are going to perform in the future, because there is different strategy that goes into making each one of these investments, in the hopes that some of you might also be encouraged to start investing and protecting your wealth from inflation, growing it slowly for any purpose you have, be it retirement, becoming a yacht owner, whatever you like. Before we dive deeper, smash the like button, smash the subscribe button, and smash everything around you. If you enjoy learning more about money, understanding how to make more money, how to protect your wealth, or simply how to use your relationship with money to better enhance your life. Trust me, it works. If you go like this, all those buttons work. And you will notice that I made these buys and deposits in the end of June because I usually like to buy my stocks at the start of the month to better plan around it. And this month I was extremely busy with personal commitments and being an awesome guy. My first investment, as always, the first thing I look towards is investing in the S&P 500, the 500 biggest companies in the United States of America. These companies are all the way from technology to healthcare, insurance, manufacturing, apparel and clothing. Whatever industry you like, you can find in the S&P 500. And historically for decades, this has returned an average of 10% per year, actually doubling the return on real estate investment, which everybody seems to think is a brilliant idea. Not saying real estate is a bad investment, just that the market has outperformed real estate on average. So I took roughly $1,100 and invested in the S&P 500 through this ETF called VFV, which is Vanguard's version of the S&P 500, available to Canada since I am Canadian. My next investment was in the NASDAQ 100. Once again, 100 of the biggest companies in the United States of America, primarily focused on tech. So if tech is not your cup of tea, if you think this is too volatile and the valuations are too high right now with Nvidia increasing 3,000% in the past few years, and Apple and Microsoft also now nearly at a 3.5 trillion valuation. If you think this is too much for you and this is too high for you, you might want to look elsewhere. But for me, I think tech is the now and the future. Every product that you love and you own, from your phone to your TV to your laptop, social media that you scroll, maybe YouTube or Instagram, all counts as technology. And this is only going to get bigger in the future with the world also joining in. There's countries out there with not so good penetration of technology yet. So my personal belief is this is only going to go up in the future, which is why I choose to invest in the NASDAQ 100, particularly through this ETF called HXQ. There's tons of ETF providers out there for the NASDAQ 100 and the S&P 500, and there's no way to go wrong with investing in any of them. Vanguard, BlackRock, doesn't matter. If you believe in the S&P 500 and the NASDAQ 100, you should be able to find an investment product that is right for you. Moving on to an individual company, my next investment was in Microsoft. Microsoft shares are going to the moon currently, but I still believe in the company and the products that it provides. Not only does it have a very big suite of old products like Microsoft Office 365, it also has amazing partnerships with up-and-coming products like OpenAI, and its cloud business is rapidly expanding with almost exponential growth rate in the last decade. So I believe they're poised to make a really big move with this AI revolution that might or might not happen. I'm just saying that they're at the forefront. And given my age, I'm in my 20s, I feel like it's okay to take a bit of a risk with an individual company, especially when the company is a trillion-dollar company that is extremely profitable. So there goes one share of Microsoft. Speaking of trillion-dollar companies that are extremely profitable, I also invested in Apple and Google. Similar logic, they're extremely profitable behemoths that have moats, or in simpler terms, that have products that are hard to compete with and almost a near monopoly. I don't support monopolies, but they do make a lot of money. Apple dominates the smartphone market, and Google dominates the search market. Even OpenAI, with all of their models, and other AI companies scrape the web and Google for the search results. So search is not going anywhere anytime soon, and Google is also honing down on its cloud offering, with Google Cloud also increasing in revenue exponentially, and YouTube being a steady player in the social media space, also in the ad space. I think both Google and Apple are safe investments. One share each of those two companies. My next two investments were in steady companies that are household names. P&G P&G and Pepsi. I don't think these companies need any introduction, but P&G and Pepsi have been steadily raising their profit and their margins over the last decade, also raising their dividend yield in the process. For me, Pepsi and P&G are more of an income play than a totally growth play. I do expect Pepsi and P&G to increase their market cap in the next few decades, but this is more about ensuring that I do get some of those dividends that are an extremely good motivating factor for any investor, at least for me. And of course, these companies are not bad companies. P&G owns practically every product that is used in your household. And the same for Pepsi. They own most of the products that are used on your shelf in terms of food or drinks. And what's more is that they have the capacity to buy up and coming brands, something that they have done in the past to increase their own product offerings. And so there goes one share of Pepsi and one share of P&G. I can only afford one share. I'm sorry. My last investment was in a cybersecurity company called Fortinet. This is a bit of an odd one for me. I don't really have a lot of money in Fortinet, but I am building a small position because I do think the products that they provide working in the tech industry are top notch. And cybersecurity in the next decade or so is only going to more than quadruple in market size. With great products and great leadership, I think Fortinet is one of the best companies to invest in cybersecurity, given that they provide essential products like firewall and endpoint security mechanisms, which are only going to be more used in the future. So one share of Fortinet, there you go. That is it for the US investments. Why is the video not over? Because I am from the Maple Land. The land of the maple, the land of the handsome Prime Minister. I want to partake in the Canadian economy as well. And so I bought VDY, an ETF majorly tracking the TSX, which is the Canadian S&P 500. The Canadian stock market has lagged the US stock market so far, but I believe with interest rates going down, which by the way, the Bank of Canada has already started cutting interest rates, I think the stock market should see a nice bounce in the future. Since a lot of Canadian companies, especially the telecom companies and the banks, have their income heavily correlated with the interest rates, of course the banks are directly affected and the telecoms finance their capital expansion through debt, which again is directly related to interest rates. I also bought some Canadian staple companies like the Bank of Nova Scotia, TELUS, and Manulife Financial, steady companies in the banking industry, the telecommunication industry, and the insurance industry. Three industries that are not going anywhere in Canada, especially with the increasing rise in population. Everybody needs insurance, everybody needs a bank, and everybody needs a phone network. And all of these companies are also an income play. Something you'll notice with Canadian companies is that the dividend yield is much higher. This is to compensate for the lack of growth overall in the stock price, but it does mean you get a nice boost of income. For example, Manulife Financial has a dividend yield of over 4%. TELUS and Bank of Nova Scotia are quite beaten down and have dividend yields of over 7%. Not a lot of money invested in these, just a few shares each, but enough to keep me interested and also get that nice income. My next two investments were in covered call ETFs. Of course, covered call ETFs are very controversial on the internet. Some people love them for the income and other people think that they sacrifice too much growth and ultimately you end up losing overall. I've gone through covered call ETFs and what they are in a video previously, so I'll just link that in the description box so you can check it out because I don't want to spend 4 minutes explaining them again just in case you've already watched that video. But essentially, covered call ETFs deploy an option strategy called covered calls that gives you more income now, but it might sacrifice more growth in the future just because the ETF has to give away a certain amount of shares if the stock hits a certain price. Once again, not a lot of money in this compared to the overall investment amount, but just enough to keep me interested and see how this actually pays out. If I actually really like the income and I'm okay with sacrificing the amount of growth that they're sacrificing, I might invest more money into them. But for now, I really like my growth ETFs and I don't see this changing anytime in the future. But I do believe with investment, just like with life, keeping an open mind is very important. So I want to see what this other strategy people are talking about actually does. My last investment was in Ethereum. Crypto, baby. Crypto is going to the moon, it's going to Mars, it's going to the Pluto and beyond. And I think the best way to invest in crypto is through Ethereum. Personally, for me, Ethereum has the best ecosystem. It has the most amount of companies building on its blockchain technology, and it has extremely good use cases, particularly for industries like finance, where a lot of companies building on the Ethereum blockchain hope to solve a lot of the problems with banks, for example, not getting your money quick enough, which I think is a good value add. Of course, crypto is extremely volatile, so I only invested a bit of my money into this, but being young and with this industry also being young, there is a probability that it actually does well and is able to revolutionize a lot of very, very dinosaur industries. So $200 gone there. Not too much, but it's crypto, baby. So those were my investments for the month of July. Let me know what you think in the comments below. What did you invest in? If you agree with me or if you think I'm the dumbest person on earth, let me know regardless. And once again, don't forget to smash the like button, smash the subscribe button, and smash the comment button if you want to learn more about money, how to make more money, how to better invest it. I hope you enjoyed this, and I'll see you in the next one.